another fine day in the world of trading Bitcoin. And if you're scalping low time frame VEPs, you know just how wonderful it can be when you have leading information to let you take quick scalps and take your profits on little hills and valleys, even while the asset seems to be moving just sideways on a higher time frame, like a 15-minute, or really anything other than like the 1 minute, right? But if you zoom in, you can see lots of walks and lots of trending moves on the 6 minute, 3 minute, 1 minute. Plenty of occurrences of opportunity to take quick trades, regardless of the day and all of that. And we've seen on the VEPs and on the VRE, today is a day with a CDR, central daily range, of roughly 1.56% of the asset's value. So, not a very tight day, but still technically under the 2% threshold to probably be a trending day, which we will see in the coming hours. There was, of course, a trending move that began at the end of yesterday's daily candle, towards the end of that candle, and then the last hour or two of that candle on the 15-minute, and it ran all the way through the first hour of the new day before ending. But again, of course, on lower time frames, you're going to have more random walks of trending moves. And since that end of that first hour of the day, it's basically been going, again, what looks like sideways, if you don't zoom in, like on the 15-minute or lower, looks kind of sideways. Well, you know, it's not really sideways, again, if you zoom in. But what we do see is that the asset is definitely set to possibly have a trending move, maybe more than one, on the 15-minute in the run up to traditional market open, and maybe even at opening bell or shortly thereafter, or even immediately thereafter. So as happens very often, it could be that the moves worth taking will happen around then, in terms of the higher time frame moves, like the 15-minute and so on. But there's obviously lots of little trending moves you can catch on lower time frames. Now, I want to get to the point of this video, which is to address what is it that, oh, I see a comment here. Let's see if I can get that comment to be legible. Walking in a very bright area, kind of hard to see the screen very clearly. Does it say, hey, what are you doing? I am walking. That is what I'm doing. But the point of this video is to remind you that FOMO will do this. What is it that it will do? It will make you rush into judgments and make mistakes. Right? FOMO will make you rush. What is FOMO? Well, if you're a Bitcoin trader or a crypto trader of any kind, you probably have heard the expression FOMO. FOMO just means fear of missing out. And it is a very common emotion that people have. It is the opposite of FUD, which is fear, uncertainty, and doubt. So yes, they're both fear related. FOMO is when you think you need to buy in now before it's gonna, before the asset you buy is gonna run to the moon or fly to the moon. And fear, uncertainty, and doubt is when you think everything's gonna come crashing down. Right? Those are the two fear-based uncertainty emotions, or emotions based on lack of confidence, or thoughts based on lack of confidence, and they come from basically having lagging information or no good information and not knowing what to do with the information that you do have. Mostly because it's lagging, so it doesn't tell you anything about what might happen next. And when you try trading with the poor information, you end up losing most of your trades because information is not telling you anything about the probabilities or the statistics of the math that actually matter. Whereas if you have leading information, you don't have fear and FOMO if you know how to read the leading information. What you have is a higher degree of confidence and a lower degree of uncertainty. And therefore, you're able to take the trades in a much more calm manner. You're able to see where the asset is running down to and at what levels it is at when it starts to turn around and go back to the upside. So you know when to long, and you can see when it's topping out at certain key levels. So you know where to take your profits and sell at the top. And that's the idea. Buy bottoms, sell tops, right? Buy low, sell high. You've certainly heard that expression before if you're a trader. It's just that most traders don't use leading information, so they're constantly in a state of FOMO or FUD because they don't know when is a good time to take their profits. They don't know when is a good time to buy. So they're constantly doubting themselves, second guessing themselves, second guessing whatever indicators they might happen to be using. And as a result, that lack of confidence and that high degree of uncertainty makes it practically impossible for anyone to make smart decisions. Which is why you want to be using leading information in the first place, so that you don't end up in a state of confusion and uncertainty. You hear the noise in the background. It appears to be some construction workers having a friendly discussion about how to build something. Or I don't know what. They're on a construction site anyway. Having an animated conversation. And frankly, it sounds a lot like market analysts having a friendly discussion about whether or not they think the market asset will go up or down based on mostly useless information. It's really not that dissimilar. It's just that construction workers tend to be dealing with these issues in a brick and mortar context, and traders and analysts are dealing with this information as it relates to, digital assets or assets traded in digital formats on electronic exchanges that they can access over the internet, unless they're working on over the internet, let's just say, or online or through connected computers and intranets and other networks. So FOMO is a real profit killer. And that is the point. FOMO will make you lose your unrealized gains because you think it's going to keep going up if you're in a good position. And you're going to over leverage your position by buying in more and more as it keeps running up, when you should actually be taking profits every time it hits key targets and waiting for a reposition, whether it comes back down or goes sideways and then goes back up again. Right? You should be not greedy, and you should be taking profits whenever it hits your targets. Can it go up and hit more targets along the way and you miss out on some of them? Yeah. But is it never going to come back down to where you were? Highly unlikely. Now, you can say, look at the last bull runs of Bitcoin. Once it departs from the station, and it goes up from, when it went up from like $1,000 to $20,000, if you didn't get in at $1,000 Once it started running, it didn't go back down to $1,000 ever again. Well, okay, but you still had plenty of opportunity to get in at the next pit stop, right? And it is always going to revert to the mean. So even if that mean is higher than where you last sold, first of all, you would have had more capital in your base to trade with than you would have had, had you not realized those gains and if it had reverted on you. In any case, you'd have more capital in your actual base for the next trade. So you can reposition for your next trade using the bigger amount of capital that you now have. And you'll say, well, but I won't get as much, I wouldn't have gotten as much Bitcoin if I had done that. Perhaps there's a probability that that's true, but that doesn't mean that taking profit when it started running and hit key targets was a bad idea, especially if you're trading on lower time frames. If you're looking only at daily time frames or weekly time frames or monthly time frames, then yeah, sure, you can miss a few percent here or there on a given day or more. Or you might miss 5, 10, 20% on a given week or month. Again, if you're trading the lower time frames, you don't really have that issue. At least not nearly as much. If you miss 1% or 2%, okay, so what? You just get back in at the next occurrence of opportunity, whether it's going up or down. So don't miss out on great trades going up and down just because of FOMO. Right? Make sure you're trading low time frame probabilities and statistics of the volatility and entropy, because that is where you'll find the majority of the occurrences of opportunity to exploit the market. All right, that's it for now. Happy trading.